Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
You are listening to the financialsurvivalnetwork.com. I'm Kerry Lutz on 1230 WBZT. Well, it looks like the whole world is caught in a giant trap of stagflation and interest rates headed higher in the U.S. That bodes ill for the rest of the world. Here to talk about it, Jason Burack. Jason, welcome back.
Thanks, Kerry. Glad to be back.
Hey, so rising interest rates in the U.S., not a good sign. What do you think's causing that?
I think initially, the Fed has obviously talked about these taper rumors, and that's gotten some people worried, but when you really dig deep behind the scenes, I think it has to do more with China and Japan and other developing areas like Russia, and then also even Hong Kong, which was pegged to the dollar. They've all started rapidly dumping their treasuries. And this is not just a 1 week trend or a 1 month trend, Kerry. This is now a 5 month in a row solid trend of massive dumping of U.S. treasuries, long-term ones. Let me give you some statistics here to fill this in. In June, China and Japan accounted for a record of $40.8 billion of net foreign selling of treasuries. The sales were part of just under $67 billion of net sales by foreigners of long-term treasuries in June, and that's the fifth straight month of outflows, and the largest since August of 2007. And we all know what happened in August of 2007. The stock market was getting ready to crash. So I'm not saying the market will crash, but I think the interest rates have bottomed. We had the 10-year, at 1.4% at one point, and it's almost nearly doubled. It's retreated a little bit from 2.8%. I think the bottom was in interest rates. I mean, maybe the Fed will start rapidly increasing QE if the foreigners start dumping the bonds more, but we're in a situation here now where the central banks look like they're starting to lose some control in the bond market.
Mm-hmm. So they're losing control in the bond market. This can only be a plus for precious metals, huh?
Yeah, I really think so. I think we put in a long-term secular bottom in June. If that was not the bottom, we're going to have a lot of bankruptcies in the gold and the silver miners in the next 12 to 18 months. There's just not the capital available for them. They can't raise equity, really. Their stocks are already, they've come up quite a bit recently, but they're still down a lot. The sentiment levels are just so negative, and a lot of these miners just have really horribly over-leveraged balance sheets because none of them expected a correction. They were all doing leveraged buyouts. They were overpaying for a lot of the larger producing miners like Burack. Were overpaying drastically for assets. Burack was even buying copper miners at the top of the copper price when they were a gold miner. I don't know why they were doing that. So there's just a lot of really, not very smart long-term moves by a lot of the mining industry in gold and silver. And you look at the supply-demand fundamentals of the market there, and demand for physical metal is just rapidly rising still in China, India, and out of Asia. And we're about to have some supply problems because even though the prices, Kerry, have come up off the bottom, and I think we're going to test some support levels around probably $13.50. We might go a little bit lower from here. But in general, though, I just don't see any exploration budgets being raised. Even the producing miners, they've cut their exploration budgets to the bone, and demand is increasing, Kerry. So if your listeners are willing to take a 3-5 year view on this from a supply demand fundamental standpoint, we're going to have a supply problem in the future. It's basically guaranteed.
It's pretty much baked in the cake, isn't it?
Well, baked in the cake in the long term. I mean, it's not priced into these stocks, that's for sure. they're still very low. So it's baked into the cake in terms of the supply demand fundamentals and how things are going to play out, I think. But in terms of valuations on the actual, gold and silver miners and things like that, none of this is baked into the cake. So I think some of these stocks could go up at least 100% in the next 3 to 5 years. That might be way too low.
Wow. Yeah, the world is quite a mess. I mean, you look at these economies, they're all in the gutter. And all these high flyers, the so-called BRICS, they're really hitting the bricks, aren't they?
Yes, they have really, really bad stagflation in those countries. Now, I can make a good argument that every single country in the world, including Japan, is stuck in a degree or another of stagflation in their real economy. In terms of Japan, their CPI is not telling the story there. Their currency has been devalued massively in the last 12 months due to Abenomics. Their stock market has done a lot, but their consumer prices are not telling the story, because when you look at McDonald's and Ford, they've had to drastically raise their prices. I believe McDonald's has had to increase prices 30% across the board at their restaurants in Japan because of the currency devaluation of the yen against the dollar. And that's kind of low compared to some of the inflation carry in these developing countries. So you have India, you have Indonesia, you have Thailand, you have Turkey, you have South Africa, Philippines, just to name some of them. And some of these countries in the last 12 months have had currency devaluations of about 40%. And this is because these central bankers are all Keynesian. They don't know any better of how to really deal with things. They tried the Paul Volcker approach of trying to defend against inflation and raising interest rates to fight off, but they didn't stick with it because, they dealt with political pressure. They had exporters from their own countries complaining about earnings and, being uncompetitive and all these other things. And this is just a problem, Kerry, with a global fiat currency system. There's no incentive whatsoever to do the right thing from a fundamental standpoint, to do what Volcker did, to run a sound currency, to develop an economy on a strong currency. People are just scared of it. So when these economies were getting a strong currency, they were either not willing to take in capital, or they were trying to put capital on conditions, and then they were drastically, issuing more debt. So when the economy slowed down, their governments had a lot more debt, and now you have a situation like Brazil where they're trying to institute some capital controls to try to prevent the hot money from leaving, or they're trying to spend like $60 billion, I believe, to try to, play games in the currency market. And the currency market is one of them. Besides the bond market, the currency markets are two of the most rigged markets in the world. The politicians and those guys love going in there and maintaining the fixed exchange rate. So you just have humongous inflation in some of these countries. The employment problem is not as bad in these countries as some of these, as in the U.S. and some elsewhere. But, when you don't have as much savings, and if you're Brazilian and things like that, than most American citizens, if your bus ticket goes up $2 or something like that, or you're paying $30 for a large cheese pizza in Brazil, you can barely afford that. I mean, the standard of living in these other countries is just going to drop even faster. And that's the way the world economy is set up right now, Kerry, is the U.S. can still export so much inflation. I don't know when this is going to stop, but I just don't think the developing world can absorb this much more inflation and stagflation. They're just getting destroyed by it.
Well, it's good to know that even though the U.S. isn't what it used to be, at least there's something that we can export that the world wants, So, hey, how much you think a Big Mac goes for in Japan?
Probably like $8. $8, $10.
Man, you know your stuff. $8.19. In the U.S.,
I was just guessing.
The U.S., it's $6, average price $6.64. I don't know that from experience. This is a website called Humuch, HUMUCH.com. Interestingly enough, when you go to the Philippines, $3.29. So if you're into junk food, Philippines is a great place to visit. If you go to the UK, it's $6.81. The highfalutin French, $7.74. Switzerland, you're looking at $12.50 for a Big Mac, which, obviously their exporters are really hurting badly in Switzerland, but they've managed to hold the line. So go figure.
Yeah, exactly, Kerry. And in Russia, it's even higher than that. Because Russia, a lot of these other developing countries, Kerry, you think that they had learned from their lessons. Like I believe Brazil has hyperinflated their currency about 5 times in the last 40 years.
Yeah, it's what they do on weekends. They hyperinflate.
Yeah, so you'd think that these guys would understand inflation and that they would say, we're willing to work with a strong currency. We want people to make long-term investments into our economy, build factories, build higher-end consumer stuff with intellectual property and things like this. And they're just making the same stupid Keynesian mistakes. they're so worried about those short-term growth numbers, and the politicians are worried about, short-term unemployment and making the GDP look good quarter over quarter, because this is all about the Keynesian economics and the politicians. It's all about the short term. They don't care about the long term, and this is the problem right now, is we have to care about the long term. We're sacrificing the long term now for the short term when it should be the exact opposite.
And this is exactly what happened when they created the euro. They never looked into the future, because one of our frequent guests, Martin Armstrong, was there, and the banks told him, Martin, can you help us? We can't tell the politicians what a mistake they're making on this euro, allowing Italy and Greece and Spain and Portugal in there when they're running these deficits. And he talked to the economic leaders in Europe and said, guys, this isn't a good idea. And they said, we understand the problems, Martin, will fix it later. And later on, they forgot all about it. The guys who were instrumental all retired to their villas on the Mediterranean. The problems never got fixed, and hence the problems that we're experiencing now. And the euro will eventually collapse, because it's this big Keynesian experiment trying to make something out of nothing. Nothing's going to happen. Hey, so switching gears, up next I want to talk about oil, what's going on there. I know that's something that you follow a lot. The price has just been going crazy. A lot of it's geopolitical, but a lot of it is based on Keynesian fiat currencies and something-for-nothing mentality. You're listening to the FinancialSurvivalNetwork.com. I'm Kerry Lutz. We've got Jason Burack. We're talking about what's going on in the world economy and what you can do about it on the Financial Survival Network, 1230 WBZT.
Hi, it's Kerry Lutz. I recently decided to move my retirement account into physical precious metals to hedge against the coming times. If you want to move an existing retirement account into physical precious metals that you can hold in your hand, tax-free, there's no company that can do it more quickly and efficiently than Regal Assets. It took them just 24 hours to open my new IRA account, and all I had to do was fill out one simple form. The best part is that Regal Assets does all the work for you. They cover the setup and administrative costs for 2013. If you're interested in making the same move I did, call 855-678-6620, 855-678-6620. That's 855-678-6620, or visit them at regalassets.com. You'll be glad you did, and tell them Kerry sent you.
We're back. Kerry Lutz on the FinancialSurvivalNetwork.com. We've got Jason Burack. Jason, what's your website again?
It's wallstreetformainstreet.com, which is WALLSTFORMAINST.com.
And we're on 1230 WBZT. So, Jason, like price of oil, it's up there. It's down a little bit today on September 4th, but it's down like it's still over $100 a barrel. I mean, we're looking oil, $107.14 a barrel. So it's down from 108. Big deal. Largely on war fears with Syria, but it's been over $100 for the past few months, and we're even seeing natural gas start to pick up a bit. What's your take on what's going on here with the energy sector?
Okay, well, first of all, Terry, we talked about this in our oil report last year, and if our listeners, we were a year early on a lot of the stuff that we're going to have that's happening right now in the oil market. So if your listeners want to get a free copy of our oil report, they can go to they can email us at our website, and we cover all the things, supply and demand, all the things people need to know about what's really going on in the oil market right now. But I'll just try to summarize it right now. In terms of what's besides the geopolitics, we just have a situation here in the oil market where the whole oil industry is spending about $620 billion with a B per year just to replace all the production, Kerry, it pulls out of the ground every single year. Okay? So we are spending more and more money, and we're barely able to move supply at all. It's not really growing. It's growing maybe 1% per year, and this is despite, the shale revolution, the deep water, the oil sands, these amazing technologies from enhanced oil recovery, Arctic oil, which is really insane, like that we're going through the Arctic through all those conditions to drill. So
Right.
we just have a lot of the supply-demand fundamentals. The economy is really not really recovering. You look at how things are doing. We talked about the developing world, how things are not doing well at all there. The U.S. is doing better relatively than some of these other areas, but that's not really saying much. The U.S. is still stuck in stagflation. It's lying about its unemployment situation. Most of the jobs being created are almost all part-time jobs. Almost all the full-time jobs created are all in Texas and North Dakota due to shale oil drilling and technology jobs. Those are the only jobs that are really being created. So why is oil so high? And I think this has to do with the fact that there is very rapid decline rates, and these are not really talked about. Okay, so you have production costs rising across the board. In the OPEC countries, the oil production costs are up 7% year over year for the last 3 or 4 years. And the rest of the oil industry in the world, according to a Bernstein study, said that oil production costs have risen by 10% since over the last 8 years. So you have production, which basically means then your costs are going to double every 7 years or so. That is insane. And on top of that, you have a supply crisis there, a cheap supply, where fracking is great. You have oil sands, which are basically you're arbitraging natural gas. You're mining the bitumen. You're heating up the natural gas to create steam or electricity, and then you're cooking the stuff to get it out. And that's a very costly operation, using a lot of water, a lot of people. You're moving earth, et cetera, et cetera. So you're just going to see the situation here where in the textbooks, over the long term, the economic textbooks, and I think these are wrong, Kerry, they say that commodity prices are supposed to fall, right? So, we apply new technologies, we do all these new things, we innovate, and the commodity prices are supposed to fall like a rock. I don't see any evidence of that. Now, maybe in the past that was true, but as long as we have 7 billion people on this planet, and a lot of these countries are subsidizing oil, even OPEC countries like Venezuela and Saudi Arabia, the demand for oil is going to remain strong. If you're paying 30 cents or $1 a gallon in Saudi Arabia or China for oil, you're going to keep consuming oil no matter what the economy says, because you probably have a job and you're getting it at a cheap price, and there's an incentive for you to do so. So this is the situation we have. We have some artificial demand that's growing, and it's growing faster than supply, and the supply we are bringing online is higher cost, and a lot of the old supply, the conventional oil production, it's depleting pretty rapidly. I'd say it's depleting at about 4 to 6% per year from a lot of the older fields. Mexico is barely a net exporter of oil. It's probably going to be a net importer of oil in less than 10 years. And Mexico used to be a massive exporter of oil. And it's like that in Venezuela. It's probably going to be like that for some OPEC countries too. So we just have a situation here where I see, and we talk about this in the Petro Profit Report, we're just going to have higher and higher oil trading ranges. But I don't know if the economy can absorb that much higher oil prices. Eventually, when we get to a certain level, it's going to crash the whole economy.
Well, if you look at Texas's oil production, and I know that the cost of the production has gone up. There's no question about that. I mean, it's obvious. But they're producing more oil than they've produced in, I think, I'm trying to pull up a chart now, but just let's say it's 25 years, right?
Yeah.
Okay, they're producing 2 million barrels a day. Now, I know on the scheme of the international market, that's not a lot. But assume that they're going to go up to 3 million barrels probably within the next couple of years, and their production's going to keep on going up, right? You see this in other parts of, here it is, I got the Texas oil, monthly oil gas statistics. So, you see this in other parts. I know that there's an exhaustion factor in North Dakota in particularly, but they haven't even really started fracking in California yet. At some point, you can assume that they will. And then you've got...
I don't know about that, Kerry, because California has many billions of barrels of shallow and deep water oil off of Santa Barbara, and they don't really allow that much. I think they have a few rigs out there, but they don't want it. Mm-hmm. So I don't know if we'll allow the shale, because California doesn't really allow mining either. So I don't know, unless California is on the verge of bankruptcy or already goes bankrupt, maybe then, but we'll see.
I think at some point the economics will rule the day, because they always do. You can only, basically environmentalism, green energy, it's an indulgence. It's decadence. And decadence will only go for so long. Once the state's bankrupt, once the country finally admits that it's bankrupt, then they'll have to go for all the income and revenue that it possibly can. And they will tap those resources, you mark my word. Forget about the greenies and all that. They'll go for it.
In the long term, I agree with you, but I don't know how many years that'll take. That could take a long time. The environmentalists are pretty well financially backed. They're backed by Hollywood, and they could fight this in the courts for a long, long time.
Like I say, once the truth comes out of the bankruptcy of the country and the state, that's going to be end game. I'm telling you, it's just reality will set in. Once it's either we take this oil or the state shuts down, there will not be a choice. And that is what it will come down to. I know it seems very far and remote right now, because the touchy-feely thing and everything seems to be okay and the economy's working and the recovery's in place. But when we get to that point, we're already past the tipping point, but when the thing shuts down, when it's all gone galt, then the decision has to be made. And look, even Obama has approved fracking and hasn't had the EPA shut it down, right? I mean, at some point, the reality will dawn and the thing will be done, and it's going to happen. Even in Florida, where I live, they're drilling in the Everglades. Did you know that? They've got a well producing a couple thousand barrels a day. Nobody knows these things, but it is happening, Jason. So it'll happen there, but it's not going to happen in a nice kind of orderly way. It's just going to happen where the will of these people is just going to be overruled by a dictator or whatever. It will happen, not to get into it too much, but eventually force will be used, and they will be forced to part with their oil. I don't know how it'll happen, but I do know it will, because eventually it just has to happen. North Dakota, nobody cares about that place, and those people want the money. Texas, they're pro-growth, they want the money. In California and Florida, they will be forced, whether it's at the barrel of a gun, the country will say, sorry guys, we love the environment, we love your coast, but we want the money, and you have to do it. And eventually that is what will happen. But in any event, let me get back to what I was saying. The production in the U.S. will take giant steps forward, and somehow this was all planned, is my point, long ago, that we would go take other people's oil, give them worthless green stamps for it for as long as we possibly could. One day those green stamps would lose their value, and then we would come back and exploit our own energy resources. I know, you think that's possible?
I think the U.S. will definitely improve from its economy, the job creation model, the value creation model of finding more oil and not importing as much. And that's always a good thing, because it's going to create more jobs, especially higher paying ones for a lot of people on the oil rigs and stuff like that. But like in the whole global, and for the oil market, people really have to look at the global supply. And the problem with these shale wells is, yes, there's a lot of them, but the data is very clear that after 3 years, the production rates, these wells can drop from 3,000 to 5,000 barrels a day initially. They can drop to under 300 barrels per day in 3 years. So you are looking at 90%, and they cost a lot more money to drill. You have to constantly drill them. You're spending $5 to $10 million per frac job, and you're constantly drilling these things. So yes, they're very profitable for the companies for a short amount of time, but the decline rates are very large, and we probably will improve things technology-wise, where we increase the recovery rates, because I believe we're only recovering about 4 to 6% of the total amount of oil that's even drilled in each frac job, which is there's a lot of oil there, but we're not recovering most of it right now. It's a very inefficient process right now. But, the problem is that's not cheap and easy oil. Okay, so all the cheap and easy stuff where we could have just drilled it once, put the spud of the well, and it gushes on its own pressure at 5,000 or 10,000 barrels a day for 10, 20, 30, 40 years, as what happened in Saudi Arabia or Nigeria or those countries, that oil is gone. Mm-hmm. So that's what I would say. I would say there's a lot of oil left in the world. I'm not going to dispute that at all, but I think it's going to be increasingly more difficult to increase yearly oil production because, like I said, we're already spending over $600 billion a year just to replace oil that cost us way less than that in the past. So right. I don't see those amount of numbers that we're going to be spending going down unless the economy just completely collapses. As long as the global central planners can keep the economy right now in somewhat of a state of stagflation, we're going to be spending a ridiculous amount of capital just to keep the oil production we have now and maybe grow it just a little bit.
Well, here's an interesting stat that I will read you from Texas. Okay, preliminary Texas crude oil figure for May 2013 is 52 million barrels, I'm rounding off, up from 39 million barrels reported in May 2012. Okay, so we're looking...
Are you talking about reserves or production?
Production. Okay?
Okay.
So we went up roughly 13 million barrels in a month, okay, from May of 12 to May of 13. I mean, we're looking at a third increase in production. Okay, so, and I don't think they're up to anywhere near their peak capacity here, Jason. I think there's a story here. I think you've got part of it, but I don't think you've got the whole story. And yes, it is very costly, and there is a curve here, a production curve, but we haven't hit the top of it yet. And I think there's a story here that we're not catching, and that is that production is going to go higher. We're looking at 2 million barrels a day basically being produced in Texas, not even including the natural gas liquids, which is a huger story because fracked natural gas wells don't have the downside production curve that oil ones do because of the porosity of the rocks and all that. Some geologist explained this to me, and I don't want to get into it, but you know that gas wells much better production curve than oil wells. So wet gas, is like one of the key secrets of American energy production. So there's a story here. I don't want to debate it with you, but I do agree that these half-life of a fracked well is much less than the easily recoverable wells of yesteryear, and the investments to keep this oil flowing are going to be much higher. And you combine this with the inflation generated by fiat currency, and we are in for some rough years ahead. And this is going to lead to political instability around the globe, including here at home. Not just food riots, which we've seen our share of, but we're looking at oil riots because those newly automobiled people in the developing world, they don't want to give those wheels up, Jason. They're going to riot when they can't buy that gasoline at a reasonable cost at the local filling station, and they have to wait 4 hours. Remember our gas shortages in the U.S.? I mean, it was pandemonium. When they're waiting to fill up their new car that they paid cash for, they are going to lose it because they're lousy drivers as it is. And now when they're subjected to the indignity of waiting hours and hours to buy that gasoline, they're going to lose it, Jason.
Yeah, and in most countries that carry, especially a lot of OPEC countries, they're not paying a free market price for their oil. So in Japan, in China, in Saudi Arabia, and Venezuela, you have some consumers paying as low as 30 cents a gallon. It was as low as 15 cents, and that oil is being heavily subsidized. So those guys that were exporting a massive amount of oil, they're consuming their own production, and they're using it to keep civil unrest in their country, preventing any riots or regime changes or things like this. So yes, I do see higher gasoline prices in the future, unless the politicians allow California and all these other areas to be drilled. I think the U.S. is going to be in a lot better shape because we do have our shale and we do actually have really good entrepreneurs in the oil industry. We have the best in the world. And I think the drillers are going to just make tons of money. They're going to mint money because the rest of the world doesn't understand the fracking techniques, and these guys are going to be able to, sell their intellectual property all over the world, and they're going to be able to use it here in the U.S. to make money. So I think for your investors out there who want to play this trend very safely, I think the drillers are going to mint money for decades.
Yep, I think you're right. I think I've always liked the energy business, but it does have its ups and downs, cyclicality. We're seeing consumption here in the U.S. It's gone down. Miles driven's gone down. Consumption's down. I think you will see countries that heavily subsidize will try to back off, and that will lead to some civil unrest for certain. They've tried it all over the world, just like cutting back the subsidy on corn, on bread. It generally has bad results and causes governments to back off of it, and causes leadership changes very rapidly. So they don't like to cut back on subsidies for any staples, whether it's energy, food, or clothing, or anything else. Anyway, Jason, just give your site again, where we find you, how we get that report, because that report, I read it cover to cover. There were a lot of good companies in there that were paying dividends, really nice-sized dividends, too. You just got paid to wait, hold on to those shares, and they performed quite nicely.
Sure. My website is Wall Street for Main Street website, which is WALLSTFORMAINST.com.
All right, and you can find all of these interviews. I think we even had a link to the report on financialsurvivalnetwork.com. I'm going to do my best to get the newsletter out this weekend. Don't forget the special reports are coming. Got one on financial health, physical health. You don't want to miss it. It's going to be great, I promise. financialsurvivalnetwork.com. Jason, as always, thanks so much for being on.
Thanks, Kerry. Glad to be back.
Jason Hartman has helped thousands of people realize their dreams of financial independence through real estate investing. And now he's got an unbeatable offer for you. He's offering you his proven course that thousands have used to build an income property empire, and it's free to the first 100 Financial Survival Network listeners. Just go to jasonhartman.com/Lutz and sign up today. For cash flow and capital appreciation, there's nothing else like it. Make your money work as hard as you do by building an income property empire. Real estate is America's proven investment. Go to jasonhartman.com/Lutz and get your free course today. That's Jason, HARTMAN.com/Lutz. Thousands have paid nearly $300 for this course, but for this short period of time, you can get it free.
The Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.